Welcome to another episode of the Bank Free Blueprint podcast. With me today, I have a special guest. I have Wallace Wong. Welcome, Wallace.
Hi, Tom. Thanks for having me today.
Yes, absolutely. Thank you for joining us. Wallace and I have known each other now for 7 years, a little over 7 years. We've done deals together. We've shared in investment opportunities together. We've also both done a reasonable amount of mentoring for other private lenders, other trusted investors that are looking to get you that are either in the business or getting into the business. And Wallace, your background really, you're an engineer by trade, and you've been in Silicon Valley here for most of your life. And I'm thinking it was 7-8 years ago, you got involved with real estate investing and started doing some lending and notes, performing notes, non-performing notes, different things like that. So would you mind just sharing a little bit of detail wherever I might have left some gaps?
Yeah, sure. In the beginning, I just wanted to explore buying and holding real estate. So I was buying and holding real estate basically in California and throughout the U.S. where it made sense, where it was cheap enough to make sense. That kind of turned into more of a chore, and so that's why I wanted to venture out. And that's when I met you. It's 7+ years ago now, in the private lending space, where it made better sense to just get passive income through that method instead of just buying real estate. And through all that, I started doing buying and selling mortgage notes as well. So I started doing the non-performing mortgage notes, but that turned out to be a lot of work. So now I'm focusing a little bit more on performing notes, which is just an opportunity to just step into cash flow.
Sure.
You just buy it and just you're buying an income stream basically, like an annuity if you understand what that means. So,
so that's sort of how we got to this opportunity to have this interview. And you had called me recently about some project that you're involved with where mezzanine financing could possibly be an option. And I suggested, well, maybe we can walk through the project right on a call where we can sort of suss it out and understand maybe a little bit what the different options are for structuring. Sure. And so maybe we can start out with that particular project, but I would also say that at some time in the near future, what I'd love to do is be able to have you join us on a call where we talk about performing and non-performing notes. And we've had guests before that we've shared information on that, but what I like about what you and I could do is we could talk about a specific deal or two. Like for instance, when you bought the note, what was the process for buying the note? When you started with non-performing, why did you start non-performing? And then now why did you switch to performing notes? And it can take the listener through the entire process of how you got to where you're at in the note buying business. So if I can ask you to come back at some point in the near future, we'd love to be able to do that on a call as well. So
that sounds great. I've actually I've actually created a presentation on this already. So so I'm kind of prepared to talk about this later. Sure.
Great. That sounds good. And for any of the listeners, maybe what we could do, I might be able to talk you into maybe giving a link or a website at the end of the show here, at the end of the podcast, where they might be able to sign up and get some information from you, or just something that'll help them understand the business more. I haven't asked you that before the call.
Okay, sure. No problem.
I know that you're very generous with what you have, and so maybe we can hook a link in later towards the end of the show. But for now, how about we talk a little bit about the specific project that you had, and maybe how you got to it and what it is that you're looking at. You and I haven't had a chance to talk about it at all yet, so I don't really know what the project is, and we're sort of doing that purposely because then listeners can see how we have the communication, how we talk about the project and how we view it sort of real life experience.
Right. Okay. So let me back up then, and I'll talk about my specific project or opportunity
Mm-hmm.
uh, uh, next. But so what I wanted to understand, and when I first heard about mezzanine financing, I think it was, and I think you were the one who threw out that term to me a few years back, and it just
Mm-hmm.
kind of kept in the back of my mind for a while.
Mm-hmm.
But from what I understand about mezzanine financing, and I was trying to put this together a few years ago when I was trying to put together an apartment deal.
Mm-hmm.
And correct me if I'm wrong, but mezzanine financing is another method of gap funding and another method of basically securing more OPM money, more money to basically close the deal.
Mm-hmm.
Normally, if you deal with apartments or other types of businesses, there is a first position in place, right?
Yeah.
Like an SBA loan or maybe a commercial loan or something like that. And then
Mm-hmm.
there's a gap in place where maybe you can bring in investors to fill that gap, between what the money that you can get versus what you need, right?
Mm-hmm. Mm-hmm. Yeah, so maybe why don't we start right there with the just a couple of definitions, just so that everybody's on the same page. Um, and some of these terms are very interchangeable or used where they overlap quite a bit. But there's gap funding, there's transactional funding, there's back-to-back funding, there's bridge funding, there's mezzanine funding. So those are some of the main ones that are talked about and kind of thrown out. And so there might be some others that I'm missing, but let's just go through each one. Gap funding. When I think of gap funding, I think of the money that's available. Let's say it's a project that needs $100,000, and let's say that there is $10,000 down by the borrower or the owner of the property, and $70,000 in a first position. So then there's a gap between the 70 and the 90,000, or 70 and 100,000, because there's 70,000 as a loan, there's 10,000 as a down payment, so there's 20,000 remaining. That's gap. So gap funding, therefore, would be the money that fills in that gap to make it work. Back-to-back funding, that's one where an example of that would be where a wholesaler might have found a property and they don't necessarily want to put the money up themselves, but they've got a buyer. So it means one set of money comes in and it's exchanged for another set of money, so that it can be done seamlessly, so that when the buyer comes in, it's proof that the closing will happen because the transactional funding is there. So it's back to back. And that's one of the funding methods that has been under a lot of scrutiny. So it's really hard to get title companies to work on back-to-back funding. It's a lot harder than it used to be. So that one's not, we don't talk about that one a whole lot. Transactional funding, though, that's one that's used quite a bit. Transactional funding is funding, let's say that there is, and what I'll just say with that, transactional funding usually will take the place of back-to-back funding. So it can be anywhere, funding that's used anywhere from a couple of days up to 2-3 years, where it's maybe 2-3 years would be, I'm sorry, I'm thinking of a different one here. I'm thinking of the bridge funding. It would be short term, like let's say 2, 3, 4, 5 days, something like that. That's typically what transactional funding is. And that just is there so that the money can be put in, the transaction can close, then the new buyer can come in and take over that loan. So that's short-term funding. The bridge funding is one that I was thinking of, that might be a couple of weeks to 2-3 years, where it's bridge funding. It's temporary funding that's taken so that eventually longer-term financing can take it out. So it bridges between what's there now and what's coming in the future. So that's sort of bridge funding. And then mezzanine financing typically is a combination of debt and equity or convertible funding that can be turned into equity if the project doesn't go exactly as planned. So I'm not sure if I'm sure you're familiar with most of these too, Wallace. So did I describe them fairly well? Did I leave some gaps?
Yeah, no, that sounded fine. Yeah, just for my specific project or deal that I'm working on, I'm just wondering if mezzanine financing would be a good fit for what I'm trying to do. So
yeah, so I think why don't we just start with that then? So can you describe the project or the property that you're thinking of, and then we'll just start building off of that.
Okay, so this is slightly different. It's not property. It's not real estate. It's actually a business.
Okay.
And so my deal is I'm looking over the numbers now, and I have the opportunity to essentially buy a book of business.
Okay.
So kind of like what I said in the beginning, my philosophy is just really just stepping into cash flow. So this business will provide that for me.
And the idea would be to buy it at a discount, and then you'd be able to take advantage. Your spread or your margin, the money you could make would be on the difference between what you're buying it for and what you eventually pay out. Right.
Either buy it at a discount or at least buy it par, close to it. I'm getting it at a discount, but the idea, even if I buy it at par, at least there's passive income that'll pay off these loans.
Yeah.
So that I don't have to think about it, and then I'll step into cash flow within a year.
And when you say book of business, what type of business is it?
This is an insurance company.
Okay, so it's insurance policies that are current. They're paying out. Would that be right? Is that a good description?
Yeah. So maybe I don't want to wear out my welcome, but maybe someday I can also talk to you about how insurance works as basically a tool for investing, right? Or maybe the way it's intended, which is basically you buy insurance in case you die and your beneficiaries get money. But I've been leveraging insurance as a way to invest for a little while now. And now I have the opportunity to buy a business. Yeah. It just so happens to be an insurance business, but it's a business that I'm looking into where I can buy these policies.
Yeah, and so what you're doing is you're basically buying cash flow.
I'm buying cash flow, right?
Yeah, okay. So this cash flow, what length of time is it over?
Length of time. So in this, I'm not sure what that means. Oh, you mean like in a mortgage note, 30 years, something like that?
Yeah, is this something that's just evergreen? It's going until they decide until their policy has either they cash it in by way of dying or cash
right. So yeah, we're probably used to buying insurance to use ourselves, but on the other end of it, people who sell insurance actually get passive income. So they sell a policy and get passive income for life.
Yeah.
Until the person paying that decides to maybe switch companies or if it's life insurance, they pass away. Okay. So can you give a little bit of details about the book? And by book of business, it just means what the collective, just for listeners, it's sort of the collection of policies that would be the book of business. Can you describe what it is that you would be buying? The book of business for this insurance company actually comes with an assorted variety, almost like a grab bag of different insurance products paying passive income.
Yeah.
Auto policies, casualty policies, commercial policies, life insurance, all that.
And how do you assess that? Do you assess it by, is it a face value that is what you then? There's a face value that says that this package of policies is worth X amount of dollars.
Yes, it's actually pretty straightforward. You look at the numbers and you see that this company is getting residuals. They don't call it passive income in that market. They call it residuals.
Yeah.
And they just say, okay, this company, this agency brings in, I don't know, $100,000 of passive income through various policies, various contracts.
over a certain period of time.
In a year, right?
Mm-hmm.
This year, because the moving part is every year you're going to have new policies that come in,
Mm-hmm.
policies that go out,
yeah,
for whatever reason,
exactly.
Competition, maybe they die, something like that, right?
Yeah. So
yes.
So the face value of this book of business that you're talking about, roughly what is the face value?
It's well over 6 figures.
Okay. So let's say it's I don't know, let's pick a number, $200,000.
Yeah. Okay.
And let's say, okay, so now we know that book of business is worth $200,000. What's the rest of the structure? How are you going to be looking at buying that book?
Okay, so the structure is basically there is a lender in place that I can go to, and they'll provide 75% of the current value of the book of business.
Okay. All right. So in the $200,000, they would do $150,000.
Yeah, something like that.
If I'm doing my math
right. Right. Yeah. It is.
Yeah. Okay. So, all right. So we know that, and just roughly, what would a going rate be for that first position lender to charge?
About 5%.
Okay. So you can get 150,000 of that book at about 5% interest, and in theory, you're making, let's say that it's paying out 7 or 8 or 10%. I don't know what the ratio would be, but let's say it's paying out 7%. So then there's a spread of 2% that's made on the money that's been invested,
right?
Even though you're using other people's money. So so that would be the spread. In this example, let's just use it. I think it's probably a little bit low, but let's just use it as a number, 2% spread.
Sure.
So what you're now, in order to buy the book of 200, are you buying it at par, or in this example, whether your case is this way or not, what would it typically be bought at par?
It would be, well, when you buy a business, it's slightly different because you're looking at buying it at a multiple.
Right.
Future
value.
Yeah, future value multiple. That seems, and a lot of times it's depending on the business. You could buy it at par if you're lucky.
But there's some sort of multiple of.
There's a multiple.
Again, let's just, well, we don't want to get into too many details here because it kind of goes off a little bit off track of what real estate is. But I guess maybe let's go at it from a different angle. If we say right now,
let's say par. Why don't we just say par to keep it easy?
So you're $50,000 short of the money that's needed in this situation.
Right.
And your goal is to somehow bring in that 50,000, I'm assuming. And so how now maybe share how your thoughts of mezzanine financing might help, or what is it that you're looking to accomplish?
Okay, what I'm looking to accomplish is to basically acquire this asset and not put any of my own money in. Right? Okay. So the current seller, I'm working with him to see if he can provide a seller carryback or seller financing for the last 50,000.
Yeah.
And as you may know, and you probably know, a lot of times these lenders they don't allow anybody to be in second position, right? And I'm not even sure if this seller would even want to be in a second position, right? They're afraid of that risk. So I seem to recall when we were talking a while back, mezzanine financing might be a better option because I can get what I want and kind of protect him as well by putting a lien. This is the part that I need to understand better. Putting a lien against the shares of my corporation.
Yeah.
Right.
Yeah. Okay. Got it. So now we'll recap. You're looking at buying a book of $200,000 worth of cash flow worth of policies, we'll call it. And you have $150,000 that is available from a lender, private lender, and
a regular bank.
Pardon me?
A regular bank.
Okay, a bank. Okay,
Yeah.
so you're $50,000 short. Your goal in this example is to get into the project without any of your own money, and you will be buying that book at par. So, or at the 200,000 par, just meaning what its face value is. So, will you be buying that through an entity? I'm assuming.
Yeah, I could.
So an LLC.
Right.
Okay. And will you be the buyer or the lender on it? Will you be a participant as a buyer?
I will be the buyer in this case.
Okay, so what if I understand it right, then what you're looking for is a way to secure it well enough for an investor that wants to come in, that's going to say, yeah, I feel comfortable with this. I feel there's enough security. I think this is a good deal. But we also have the restriction that the first position lender or the bank doesn't want to allow a second lien or a second mortgage or second against it, any sort of debt behind it directly on it. So this actually ties in really closely with one of the strategies that we do when we are lending money to contractors and developers. And I'll just briefly share that description, and then we can see how it ties in. That is, when we have a developer coming in and they want to borrow money against a property or borrow money for a property, we generally will require that they come in with a brand new LLC, a single purpose new entity LLC. That entity then will become the sole borrower of the money, and it will have the property in that entity. So so that's how, because it's the borrower, that's how it's tied together. So what we'll do is, in most cases, we're going to request that the borrower, the developer, especially if they don't have quite as much cash into the deal as a bank might require, then we would have them sign over their membership units to us, but they would be held in a third-party escrow account.
Okay.
And what that does is, well, first of all, then it would be tied in with a performance contract or a performance note that states that at certain milestones, certain things will be done, certain timelines will be done. And if these milestones and these performance criteria are not met, then we have the right to go in and take over the project and finish it. Let's say it stalls out for 4, 5, 6 months and nothing is happening. Rather than going through the foreclosure process, which in some states it could be really long and just be a big hassle to go through the full foreclosure process, what we'll do is, because of that performance contract that's tied with it, that's with the membership units that are held in escrow, third-party escrow again, that third party, which is typically a servicing company or a title company, will know exactly what to do with those membership units if something happens. And by something, I mean either the borrower performs and everything works out fine, that something then triggers those membership units to go right back to the borrower. If something else happens, and that would be, let's say it's lack of performance or no performance on the project, then after it's met the criteria that's required on the performance note, then it triggers it to come over to us, because now we are in the position to finish the project that the developer didn't finish. And so that's a way to make it work faster, smoother than a standard foreclosure would do. It keeps it cleaner. And a lot of times the developer is willing to do that, number one, because they believe in the project, first of all, that it's going to be successful. So most of the time they're just not going to have an issue with it, because they just feel very strongly that the project is going to be successful. On the other hand, let's just say that there is a developer that kind of puts up a flag and says, I changed my mind. I don't want you to be able to get those membership units. Just like anything else, there's a chance that it could be litigated. It could get caught up in I've checked with a number of attorneys, and they said it's completely legal, legit. It's a good way to do it, but like anything else, things can be contested.
Sure.
My answer to that is, well, then let's still do it, because the worst case is it gets contested. Then immediately you start the foreclosure process. And so you're not any further behind than if you hadn't done it.
Right.
So,
but it's not a foreclosure in this case, right?
Right. So the goal is to make it not be a foreclosure. But let's say that the developer changes his or her mind, and they say, no, I think I don't want to just give it up that easy. Then it just has to go through the standard foreclosure process. So it's like you get the upside of doing it, assuming it works, and there's really no downside if it doesn't work.
Well, but the downside, sorry for interrupting.
Oh, no.
I'm just thinking the downside. So then, okay, so let's say you contest, the borrower contests it, and says, oh no, this is mine. They're kind of doing something shady. You know, you the lender go, no, they're contesting you. And then that gives the first position time to foreclose on the project, and they take it back. They own it. They essentially wiped you out of the first position. Still wipes you away, right?
Well, that's assuming there's a first and second. But in this case, the way it would, if you're in a second position and you're doing this type of a structure, you just would never let it get to that point.
But there is no position. There's the bank financing in first position, and then if you do mezzanine financing, there is no second position. It's just against the LLC, right?
Right. Okay. So then it would be, I see what you're saying. So then it would be a matter of going either by way of a working with the first position lender side by side with the first position lender to get that covered. Yes. If you don't have any note or any entity lien against it. Yes.
There's no note. Okay. So then in terms of paperwork, if you do mezzanine financing, there's still a promissory note, that's for sure, right? Is there a mortgage or a deed of trust, or how does that work?
Well, in my experience, there typically is a note and a mortgage. There have been some cases where we've been involved where there was no mortgage in that position. We weren't doing it ourselves, but it was a couple of cases where I was mentoring some people through it. But yeah, it typically would be a combination of a debt and equity play, so it can be used as part of it as debt, part of it as equity, but it generally would have some sort of a lien against the property,
like a second position. So it'll be like a deed. If you're doing California, then it'll be a deed of trust that's tied to some language in the newly formed LLC that says, hey, this is a performance LLC. If you don't perform, then I can trigger my right as a member, and take control of your LLC so I can finish the job myself. So it's kind of a two-prong approach. Is that accurate?
Yeah. And so the way to really, if it's real estate involved, then it would be a matter of going through the foreclosure process of real estate, but that would be done by way of tying in with the first position, working with that first position, assuming you're doing a first and second. But in the case of these notes, there really is not going to be any sort of a recorded document from what I would understand as far as a lien against it. So it's probably a UCC filing or some other way of leaning it. So then it's going to be the contract between you and the seller that's going to have to stand up to the scrutiny. Was that contract written in a way that it would restrict you from being able to do that with the LLC, with withholding the LLC?
I see. So in real estate, the way that you've done it in the past is basically lend money and put it into like a second position mortgage or note,
Well, the
Yep.
ones that we've done have been the first position.
Oh, you bet. Okay, even better.
Yeah, so
So,
we haven't come across that issue with the second. There actually are a couple of cases where if we did some second positions earlier on, so there are a couple of those projects that we have where that would trigger if that were to happen, but it hasn't yet. So, but
okay.
but with the first position, it really is just taking the entity that owns a property rather than the property itself.
Oh, I see. So it's just added paperwork. You were the first position lender, and you put some special provisions with the operating agreement in the LLC saying that if you don't perform, because
Yeah.
I owe X percent shares,
Hmm.
I take control of this LLC, which means I have the right to basically kick you out and
Yeah,
kick
to
the
take over and
borrower out.
finish a project. Of course, our goal is never to take over a project. We've only, in all the years we've been
Okay.
doing this, we've only foreclosed, I think, on 2 properties, and that was with one borrower that just was just not a good person.
Got it.
But yeah, it's and that's why that scenario isn't exactly the same. But I explain it that way because that, I think, in your case could work out well because it's not putting any sort of a lien against the documents themselves. It's putting a lien or an encumbrance, I guess would be a better word, an encumbrance against any of the documents themselves, but it's putting an encumbrance against the entity that owns those documents.
Yeah. Okay. Yeah. So I can conceivably, in if I'm going to buy a book of business, a business instead of real estate, this can still work because I'm trying to not put any of my own money in,
Mm-hmm.
have the seller finance the gap, the 50,000.
Mm-hmm.
We can create like maybe a second position loan, and then we could both be in an LLC together where there's a certain level of performance that I need to perform, or
So
at least
you're assuming that in this case, so you're saying that the seller would do carryback. And just for anybody
maybe, yeah.
listening, if there's any question about it, the seller carryback just means that there would be that taking the equity, that the value, that piece of, in this case, this example, where there was 50,000 remaining, that they would possibly take that back by way of a note
Right.
rather than by cash. So that's a form of seller carry. There's also a subordinate seller carry, which doesn't really apply here because that's more in real estate where then it doesn't become a lien against property.
Right. So it's a win-win, and I'll tell you why. For both of us, obviously for me because I don't have to put any of my own money in, and he can fill that gap by it's essentially installment payments. I'm paying him in installments
Mm-hmm.
with interest.
Mm-hmm.
The benefit for him is that if you sell anything, any kind of gain is taxable. So
Mm-hmm.
if you sell property for $1,000,000 or
Yeah.
something, it's taxable, right? So
Yeah.
by having him or having me pay him in installments, his tax liability is lowered for that year.
Yeah, and what it really reminds me of, and there were a lot more of these. I used to do a lot of these in Minnesota back in the 90s, 80s, 90s, and that was wrap. It was a wrap
Oh,
of a mortgage. So it was taking it subject to the first. So in this case, you're wrapping. His equity is sort of a wrap on top of the loan. So the lender gets paid for the loan for the money that's there. The seller gets paid for the equity
mhm.
that he has in it, and he's getting it paid on a monthly basis rather than all of the cash up front. And that's where you're saying the tax benefit could come into play because they aren't getting all of their income at
Right.
one time. They're getting it spread over the 3
Spread
years,
over
5 years, or
X.
however
Yeah.
many years it would be. Mm-hmm.
Right. So that's to me is a win-win. But I wanted to also, I've been on both sides of the
Mm-hmm.
lender and borrower world now, so I want to make sure that he's protected. So then, therefore, uh, if I can structure it where where, hey, if something happens and I default, then he gets the book of business back, and it's no harm, no foul.
Yeah, or maybe there's a way to do it so the payments are assigned. Maybe
Yeah.
because you're getting cash flow from that,
Mm-hmm.
maybe wherever you're getting that cash flow from, that can be directed. It can be there can be an assignment, so you assign a portion of that cash flow to the first position or to the bank, so that then the seller of the pool or of the package knows for a fact that that's getting paid off.
Right.
Then they can also the seller of the package can also then direct. You can have them make the payments, like do a holdout, or make the payment actually to that, to the investor that you're talking about, the other investor that comes in. So it's a matter of directing payments so that everybody knows if there's a payment missed, they know it immediately. But if the cash flow stream is solid, and you would never do the deal if you didn't have a really good good evidence that it's very, very likely going to work. Otherwise, people wouldn't invest in it. And so you want to make sure that trail is very clear. You make sure that they've got their security, making sure that it's a good investment. But assuming that's all in place, by directing the seller of the package where to make those payments, they don't have to worry that you're collecting payments and not making payments to someone else, to the party down the line.
Okay, so it sounds like mezzanine. I don't even have to do mezzanine financing.
If you can get the seller, if you can get seller carryback, that'd be the easiest.
That's
and
the easiest.
Another
Okay.
investor, that would be the second easiest.
That's okay, great. Yeah, I was overthinking it.
Yeah, I don't know that mezzanine would necessarily be a requirement. It's more, yeah, it's
Okay. I can see why you do it, because you want to guarantee the performance of the borrower.
Mm-hmm.
But for me, for this case, less critical, I would say.
Mm-hmm.
Yeah.
Mm-hmm. Yeah, that's because there's, correct me if I'm wrong, but it's less critical because the stream of income is
consistent, is
predictable. It's a track record. It's something that it's, I don't really know how to say it other than that it's a very reliable source of cash flow, assuming that you've done your due diligence to know that the source is who they say they are.
Okay. Great. Okay, that answers my question.
Yeah. So, yeah, I'm not sure if anybody, I will say anybody that's listening to the podcast, if you have any questions on this, Wallace, is there a way that people might be able to reach you if they had questions on the structure
Sure.
or interest in knowing things about the notes, or even that report that you had?
Okay. Yeah. I'll give you my contact info, and then unfortunately I have to get going. But I have a website. It's actually www.cashflowingnotes.com.
Okay, cashflowingnotes.com.
Yeah, cashflowingnotes.com. And
we'll
my
put
email.
That in the show notes, and so if you're driving, don't worry about writing that down right now. It'll be in the show notes, so you can click on that. And
my email. My email is wallace@cashflowingnotes.com.
Okay.
And I actually have, if you go on my website and you subscribe, you sign on, you can get my newsletter, which basically talks about notes in general. A little bit, it's education. It's basically teaching you why notes make sense. What is a note? Because
the basics of note.
Yeah. Because if you Google it out there, everybody's focused on non-performing notes because they think it's a lottery ticket every time they buy something like that. But it's a lot of work.
Yeah.
So what I try to do is step into cash flow, and provide that for my investors.
Yeah. Yeah, great. Yeah, so we'll get them in the show notes, and be interesting as this project of yours progresses to keep us posted and let us know how it goes. And anybody that's listening, if you like what you're hearing, if you like the content, If you can share this with a friend, share this with somebody who you think it might be valuable for. If you have an opportunity, I would really love it if you'd be able to write a review on iTunes, because that helps get us a little higher in the rankings. And this podcast is really, it's no pitching. It's just, it's training, teaching, giving back. It's about helping everybody else do better, because I really believe in the cycle of abundance. The more we give, the more we get back, the better we do. So we can even give more, get back more, do better. And it creates a cycle, and it creates ripples. So everybody does better. It's the abundance mindset instead of scarcity mindset. It's collaboration. It's working together instead of scarcity, fear-driven, greed-driven. There are so many better ways of doing business than the way some businesses have been run in the past. And so just collaboration, working together, abundance, that's what we're all about. So if you have a topic that you'd like us to cover, if you have any questions, you can email me at tom@tombraegelmann.com. That'll probably be in the show notes as well. And subscribe to this podcast, tell your friends. And yeah, so with that, Wallace, I really appreciate you taking the time, and we'll look forward to another episode where we can talk about notes or life insurance or those types of things. So.
Sure. Yeah, thanks, Tom. Really excited to be here.
All right.
Thanks
you.
again for your help. Bye.
Bye-bye.